Good afternoon, everybody, and welcome to Live Market Analysis Macro Edition. That's indices, commodities, foreign exchange, and dare I say, crypto if you want to go that way. My name is Carl Capolingua. I'm the market analyst over here at ThinkMarkets Australia. It's a pleasure to be with you as we head globally to find the best opportunities for your trading, but also, I think, just as importantly, to understand how the global macro impacts your portfolio. Pretty simple methodology today. It's your questions versus my technical analysis. Pop in your requests to the Zoom window if you're watching me on Zoom, but you can also access the requests there on any of your streaming services that you're watching me on. So YouTube, LinkedIn, Twitter, and Facebook as well. Let us head over to, because the first, I might just do a bit of a whip around the grounds first. So let's head over here to the AMI Broker screen and kicking off where I like to kick off, which is with interest rates. And you might say, hey, Carl, why do you start with interest rates? Because, ladies and gentlemen, whether you know what a bond is, a bond, a note, whatever you want to call it, a bill, they all represent the price of money, especially when we're talking about government bonds. So what we're looking at here is the Australian 2-year government bond. It is the most used proxy for short-term interest rates in Australia. And the price of money in Australia is increasing. In fact, we're nudging now about 4.2%. And if you've been searching, like I have actually recently had some reason to park some money for a little while between using it for something else, and checked out some term deposit rates, and they were upwards of 4% now, depending on who you go with. So that's pretty impressive. We're talking about, I guess, competition for the stock market. So your average stock market yield, coincidentally, is about 4%, give or take, for the Australian market. In some years it's better, some years it's worse, but currently around about just over 4%. So what we're talking about here is the competition between cash sitting in the bank versus sitting in the stock market. Most people say, oh no, stocks are the best way to go because, you know, the stock market goes up. Well, generally it goes up, but not always. And that's the attractiveness of cash, the certainty of getting your money back. And you can get a bit more than what we're seeing on screen if you go for some corporate bonds as well. So this allure of cash, this allure of certainty is very strong at the moment, and that is suppressing potentially the desire to own something like this. And I'm going to show you the Australian stock market at the moment. Oh, well, something wrong there, isn't it? And again, we're talking about how much cash is competing with the desire to own shares, because shares are risky, ladies and gentlemen. Shares are a giant big ball of risk. And you say, no, Carl, my shares are safe. I've got all blue chip shares. You're kidding yourself, right? Shares are a great big ball of risk, and you must look at your investments in the share market in that way. And if you can look at your shares as a great big ball of risk, you're more likely then to do the right thing when they're not going in the right direction. So we've got a big problem here in Australia. The other problem, of course, is for the share market is as many companies have borrowing costs, don't they? So it impacts their bottom line. It is on the expense side of the ledger, not on the revenue side of the ledger. We'll talk about that in a second. So when the price of interest rates go up, you have to spend more to service your debt, and that eats away at your bottom line. The other side of the equation, of course, comes and hits your revenue, because all of us lowly human beings here paying off our mortgages have to pay more interest. We've got less to spend, and that is less for businesses' revenue. So a big hit when this is going up. And hey, that's the last price there. If that was a stock chart, we'd be all over it, wouldn't we, ladies and gentlemen? We'd be buying the hell out of that. So it just gives you an indication of where the trend is. Of course, what we're seeing here with yields going up is bond prices coming down. Let me just quickly show you the one in the USA. It's not as rampant to the upside, but it certainly is increasing. We had a pause last night. Oh, sorry, a skip. Is it a skip or a pause? I'm not sure. Whatever happened last night, Australian time, Jerome Powell and his buddies over there at the FOMC did not increase interest rates. So that's the first time since they began their hiking cycle. Still heading higher there, market factoring in higher rates down the track. And to what effect? Let's have a look here. And we can see that pre-pause last night and post-pause, we can see that the hiking column has increased fairly modestly. If we look at sort of pre versus post, so pre is the 13th of June on the left, post is 14th of June on the right. And we can see there probably the biggest impact comes in November, where we're only 50-50 for a hike there. Now we're pushing into 63%. In December, you can see we were about 39%. Now we're back over 50% there. And these are the highest levels we've seen for a hike through this whole cycle for the latter months of 2023. Previously, they were very, very low. In fact, previously the skew was towards ease for the latter months of 2023, but now we can see in the ease column, head over to the ease column, left and right hand sides, and you can see that the ease is evaporating. Yesterday, an ease in November went from 8% down to 3%. In December, from 20% halved down to 10%, and in January, from 40% down to 28%. And then in March, it's only really until we get to sort of March that we're over 50%, but that's down substantially as well. And then we're looking at May as the most likely rate cut from the Federal Reserve next year. Fascinating stuff, and obviously going to have a big, big impact on our stock markets. With that in mind, let us head to some of those indices. That's okay. We'll stay on screen for a second, which is the ThinkMarkets web trader platform. Amazing platform. Definitely go check it out. We'll look at that in a second. But where I wanted to head was over to here, where I've got a bunch of easily accessible stuff. And that's the US dollar index. We might come back to that one. I want to head over here to my indices watch list. And look, I'll just quickly show you some of those, obviously reinforcing what we saw with the Aussies, Aussie twos, and then we see the European twos, obviously rising, the German twos more specifically. In the UK, that is probably the steepest ascent of them all, and this is going to have an impact on the foreign exchange pairs we'll talk about very, very soon. And then we compare and contrast. Have a look at the Japanese yields or lack thereof. Ladies and gentlemen, did you notice what is happening here with Japanese yields? We saw the Aussie yields approaching 4.2%, but the Japanese yields are negative. We've got negative yields in Japan. Basically, it's costing you money if you're storing it. The Japanese Bank of Japan trying to stimulate their economy. Yes, their inflation numbers have gone up, but nowhere near like the rest of the world. So they're still very much in that stimulatory stance. Negative yields over there. And then we head to New Zealand. It's one of those important funding currencies for your carry trades. I know that didn't make sense to most people, but it is important for your carry trades. And then we've got the US yields there. They're about 4.7%. So you can see the Aussie yields are actually still relatively low compared to the US yields. But it's all about the outlook and where the markets are thinking they are going. But the trend there is certainly up in yields. Now, ordinarily, what we'd expect is higher yields to hurt this chart here, which is the NASDAQ Composite. You know, I've been very, very bullish on the NASDAQ Composite since around about February, and I've stayed the course. I've had a couple of periods of doubt, but I've stayed the course, and so far that is paying off, hopefully for you as well, because you've been following my analysis. But there's nothing really so sinister in the chart there to suggest it can't continue. I think what we saw in the yields has confused a lot of other analysts. Didn't confuse me, because I don't let that stuff change what I see on the chart and how I interpret the chart. So yes, you could say, oh no, yields are going up. That means you should be selling tech stocks because they're the ones with the longest duration in terms of their earnings. I know, fancy words, but it means they tend to have a lot of debt because they're often starting startups or early in their earnings cycle, as opposed to say a big stalwart like GE, which is very much a lower growth, paying a lot of dividends. These guys, they don't pay any dividends typically, and they're investing for growth. So they tend to be funded by debt. That's a big problem, obviously, when yields are up. So a little bit counterintuitive, and I think it caught many other pundits off guard. For me, it's just about following the trends. The trends here are still fantastic. I did mention in a tweet earlier on today, I gave you some levels. Look, maybe we'll head over here there, just simply because it's the quickest way to access it. I think you'll agree. There we go. 13,711. We might see some supply around there. How is that supply going to manifest itself? It's how supply always manifests itself, ladies and gentlemen, as black candles and or upper shadows. Black candles and or upper shadows, the supplies come into the system. The profit taking has finally arrived. 13, 7, 11. Watch for them there. Last two candles you can see, we're fine. In fact, last three candles, absolutely magic, no problems at all. And then I said in this tweet, maybe 14, 6, 4, 7 is our ultimate finish line for this move. Wouldn't that be wonderful if we got up there? And you just imagine the bears screaming bloody murder if we get there. Nothing would give me more pleasure to see this bears screaming bloody murder when we get there. Let's head back over here. What did I want to say? A couple of other points I wanted to make just on this one. And I did read, and this person will remain anonymous, but somebody in a very similar position to mine, and they noted, and everybody's entitled to their own opinion. I'm not saying it's wrong or right, but I'm just saying that they noted that this candle here was a quote-unquote hanging man doji. And quite correct, often when you have a small-bodied candle with a long lower shadow, in a nice uptrend, the textbooks, the Japanese candlesticks textbooks would tell you that's a hanging man doji, and that can be quite bearish. I view it the exact opposite way, and you know why, ladies and gentlemen. You know, because I say, look, white bodies, lower shadows, just equal demand. The market gapped up. Normally, a lot of people say, oh, that's got to be bearish. When it gaps up, its gaps have to be filled. Well, actually, a little bit did get filled here. As you can see, yes, it gapped up, bit of profit taking coming in. But what did the profit taking find? It found a bunch of demand where the demand was finished off yesterday. The demand just finished here yesterday, and it came back in at that point and pushed prices up to the top again. So for me, I look at this as a demand side candle. I say it's very bullish, not very bearish. It's the opposite of what the textbooks are telling you, because let's face it, textbooks often written by people who don't think about stuff too much. That's my honest opinion. And then we see last night is really just amplifying the bullishness of the night before. So everything's pretty hunky-dory. They're happy to stay the course. And on Tuesday, somebody asked me about NASDAQ shorts. The local, on the Australian Stock Exchange here, their local NASDAQ short ETF. I admonished them, of course, but I think they were asking about it more from a hedging perspective. I'm not sure you want to use this to hedge necessarily. I think maybe if you wanted to hedge something, find an ETF that maybe is targeting something that is a major problem for the world, of course, and we're heading over here to the US banking sector, and maybe target this to go short as a hedge for your long side portfolio. Now, I wouldn't necessarily look at that straight up and say, well, that's a glaring short trade, because the price action's actually pretty good here. So if I'm going to go short something, generally I want to see price action that confirms it. But I get this idea of wanting, almost needing to have some exposure there. And what I need to do is, there's a continuous draw here somewhere. I've forgotten how to use it. I'm not the expert on drawing. Is this it? High drawings. Maybe it's this one. Lock all drawings. I know the people who are experts here are shouting at their screen, but let me just do it the manual way, and like this. And this is why I tend to be an Amy broker. But we can see a little bit here. I'm not sure if I should draw the next one, but the price action is still pretty good here. Last night's big black candle is a big concern for me, not just in terms of what's happening here in the banking sector, but obviously my long positions in the NASDAQ and tech stocks. How much is banking going to impact tech? I'm not sure. It hasn't done a whole lot, let's face it. Almost through the entire hashtag banking crisis, NASDAQ's gone up anyway. But I do think if something bad is going to happen to the markets, it'll happen from here. This is the chart, and it's best buddy, we're going to show you in a second. These are the charts we need to watch for warning signs that the financial system is starting to unravel. Last night's candle is not great, but it's not the end of the world. But the reason why I came here is I said, look, if you want to short something, don't short the NASDAQ, short this one. Short weakness, don't short strength. Often people go, oh, that's gone up a lot, it must go down. It's gone up a lot for a good reason. Don't short that. Short the stuff that's already weak. So we looked at the regional banking index, and now this is the bigger banks here. Their trends, that uptrend is fragile, I would suggest, and the downtrends in both cases are well established. Another place you might want to short in terms of looking for weakness, we can head over here. What I'm going to show you now is the China Mainland Real Estate Index. Now, I'm not sure how you could exactly get exposure to it. I'm pretty sure we don't have it. But this is telling you here. Now, think of all this talk over the last couple of weeks. And by last couple of weeks, I mean through here on the chart, of all this stimulus that's coming from China. The People's Bank of China did actually drop their reverse repo rate by all of 0.1%, So from 0.9 to 1.9 to 1.8, correct me if I'm wrong, which is the tiniest of tiniest drops. And all that really is the reverse repo rate, the overnight rate that they charge banks, pay banks to hold cash with the central bank. Obviously, if you lower that, there's less incentive for banks to hold that overnight cash, more incentive to get it out there in the economy and stimulate the economy. So that's what that's all about. Apparently, there are rumors, just rumors, this Bloomberg, Reuters, quoting various government officials that we're going to get as many as a dozen individual stimulus measures coming out sometime this week. And that's why we've seen iron ore rally substantially. We'll look at that chart in a second. BHP, Rio, Fortescue locally, they've had a great run as well. We've seen nickel and copper heading up, all on these rumors that this is going to happen. I love rumors, don't get me wrong. I hate it when they turn a trend around like they've done, because generally I'm, short these things. But let's keep an eye on this, because I think this is starting to roll over again. Because let's face it, the Chinese property market, it's been a zombie for a long time. And, there's only so much I think you can do to the zombie. Lowering rates, I don't think is the ultimate solution, because I'm not sure how much that's going to stimulate demand. And we really have a demand side problem here. So, look, maybe they will, maybe they won't. But that is not the most emphatic show from the bulls that this is turning around, because we've hit that short-term trend zone, and we're showing the higher shadows there, the shadows pointing up, and the black candles, and even on today's candle, that we're probably going to resume that downtrend. So just, I think take this idea that we're going to have this big stimulus coming with a little bit of a pinch of salt based upon the trends. And until these trends really meaningfully turn around, and I'm talking about, high peaks, high troughs, big white candles, that's going to be the key. The big white candles that we saw late last year when, quote unquote, there were rumors that we were going to get a reopening. Now, they turned out to be true. So if this turnaround turns out to be true, actually we'll probably see not just one little white candle when the news first breaks, but I think some substantial other candles. That's the A50 shares. Watch those. I'd say closer than the headline one here, the SEC. Because it's the mainland. This is China. This is confidence of mainland Chinese people versus confidence of fund managers. Let's face it, there's always capital flowing into these emerging market funds. I think I've shown you everything you need to know there. But the theme was finding stuff to short to hedge yourself. I do want to talk about the Nikkei today, because it was requested by, I can't remember who it was on Twitter. I should remember the name. Patrick, I think it might have been. Oh, what a monster. Now, the problem with this monster chart here is last week I saw this big black candle, and I said, sell 1/3 of your position. We had a long trade, not recorded. I think it might have been here, or certainly around here. It was sub 30,000. So let's say, hypothetically, and I do want to talk about this, because it does get to the heart of how I do things. So let's go here. It might be in my watch list. I'm just looking for it. It's not. We go Japan Yen 225 for obvious reasons. It's the Japanese Nikkei 225 index. And when we go to our trade here, tradecraft. So, how do you implement this idea of getting in thirds and selling out of thirds? Well, you can't really get out of thirds if your minimum amount is 10. So you kind of have to start here, if you get what I mean, right? So you've got to start at 30, and that might change your reward to risk, or not so much reward to risk, but change your risk profile. Because we can see we go from potentially 10 cents Australian for each pip movement here, I'll talk about that in a sec, to 30 cents Australian. Now, probably not going to be a big deal for most of you, but it does give us this ability to enter in thirds and sell in thirds, right? So the pip is always of the two big numbers on every quote on the platform. It's the rightmost of the two big numbers. So you can see when we go here from 33679 to 0.3681. That'd be 2 pips, and you'd make all of 60 cents. Okay. So if you got in sub 30,000, you could just imagine how many pips you've made along the way if you followed that idea. And through here, what you would have gone and done based upon this bearish candle, and it is a bearish candle, make no mistake, you can see it actually followed through the next day. An incredibly bearish candle, I think totally warrants, and even with the benefit of hindsight, it's gone up so much. I still think the right thing to do was to knock out, and you would have gone to sell this time, sell 1/3 of your position. Now, the bad news is it kept going up, so you're a little bit annoyed that you got out of 1/3 of your position, but the good news is you've still got 2/3 of your position remaining. Okay, so we're starting to see how to follow this methodology through. And some of the beauty and the benefit of this methodology is you're never all in, you're never all out. It'll take a pretty decent move to the downside to get you all out, but we aren't ignoring those signals in the market. You know, we're at least locking in a little bit of profit here. So the question then becomes, okay, well, smarty pants, what do we do with the Nikkei now? Let's head back to the, just double take there, head back to this one here because it's just got all my indicators on it. There's nothing in there that suggests you would sell your other 2/3 of this position. So a happy holder. Could I add some? It's a little bit of a ways away from the light green zone. I know the person that asked this question, they are long the Japanese ETF here, the exchange traded fund on the Australian market, which I've been tweeting about many, many times. If you don't believe me, what's it, I can't remember the exact code, but it'll be in here. I'm going to reveal who asked me the question. It was Patrick, and it was the HJPN. Well, there you go. You can see where I've tweeted it on the 2nd of June and probably before that as well. But that's probably how they got onto that idea. So a couple of ways you can follow me. Obviously, follow me on Twitter, and you get my my daily shortlist there. And of course, tune into these sessions here. Let us quickly head back then to here. And I just want to finish that whip around the grounds. So staying along there. The other stock index that caught my attention was the DAX. Now, this has closed at an all-time record high. How about that? So let's, we might zoom that out. We'll use let's go a monthly chart. And just to prove it to you, just in case you didn't believe me, I know you believe me. There's the, let me escape that. There's the DAX. Let me see how much history we could get there. Oh, that goes back to 1971. What an amazing, amazing looking chart that is. And you can see when we get to a monthly chart, the dark green zone was never challenged. But my gosh, look how well. And again, this is a great illustration that it doesn't matter what periodicity you use for my ribbons, they work, ladies and gentlemen. Look at that. Look how well that works. I mean, if you were trading on a monthly basis, that is what I call the value zone. Okay, so my trend ribbons on the way up represent the value zone for going long, and on the way down, when the price gets up to them and gets stopped at those levels, it's the value zone for going short. Let's go to the weekly chart. Just have curiosity here, see how well or how bad it works on the weekly chart. Look, not as good through there. Happy to admit that, but go away. Certainly pretty good through there. A little bit more flexible, but I would put to you, ladies and gentlemen, still darn good here. And that's just the last bull market. Go and check for yourself. I'm sure it worked through the one before that, the one before that. Okay, what are we doing with the DAX? I think we can take long trades here. I don't see why you can't. Look, I think probably 2 days ago was the signal. You could have got in at an even better price. Last night's candle was, second from last night's candle was magic, and last night's candle is still fine. Maybe we're seeing a little bit of supply coming in from that previous high there, but I don't think it warrants us not being in it, to be fair. Now, that would, I think, depend on having a really solid and safe. I was going to say safe. Safe's the wrong word. Solid stop loss. I think we need to get stopped down here somewhere. Okay, at the very, very least. But I think it's worth having some risk here, putting a toe in the water. I won't show you the picture of the shark, but I think that's where we want to go. So how do we find it on the platform? I'm pretty sure we go, I mean, I think the platform's pretty neat because if you don't know what the individual, if you didn't know the Nikkei was in Japan or the DAX was in Germany, you could just type in Germany or the country and it's going to help you find it. So that's the one we want there, the German 40, the DAX 40 index. And obviously this will update to the right parameters here. So how would we do it? Well, I mean, you don't have to do this, but we tick it up to 0.3 because that gives us the ability down the track to sell 1/3 of the position. Okay, so we go from 16 cents Australian risk up to 48 cents Australian. Okay, and it'll matter when we get to here as to whether that allows you to do the trade based upon your risk tolerance. Okay, and I don't know what yours is. You need to decide that. But we did want to get our stop loss sort of under here, and that low there. If I go, is it this one here? There we go, and here, and let's say sort of a 15,837. I think sounds pretty reasonable. So let's go 15,837 in our stop loss, and we can see that if all goes horribly to plan, we're up for $217. You might say, no, Carl, that's I'm not interested. It's too much for me. Well, then you're at 0.1, but you can't get out in thirds. You're just in and out, right? But that, again, up to you what you do here. Now, what's our target? I don't know what our target is. It could be anything. But if we use a measured move, I mean, at least this much, again, sort of from that, 15, 16, let's call it 15.9 up to the current 16.4. What's that? 400 points. There could be 400 points in it. So let's say we got in here. Let's add 400 points to that. So just put a 7 there. Is it 1-to-1? Look, it's actually pretty close to, and that's just on a measured move basis. So I could happily do it. I won't put this in. I don't believe we need to put this in. So I would turn that off. But I would use it just to work out if I can get 1-to-1. I think we've confirmed that. I could tick this up if I needed to get to 210 just to make me feel better about it. But I think just on a measured move basis, and what a measured move is measuring the last move up and then projecting it from where we are, okay? Because we have hit this little supply zone here. And then we would obviously hit the buy button and it would go through. I think we're pretty good, and leave the stop loss on there. Okay, but we might have a reason to get out before that. So just because it says 217 doesn't mean that we are destined to lose $217 because we have a methodology. And if we saw it, even if today it never traded higher, and what we saw was the DAX do something like this, right? And just think in your mind's eye, look, how many times have you seen something like that? Well, we'd be looking to get out, not through there, snapping, maybe that's what that one is, snapping to the, so, yep, still not doing it. Let's do that one. And there we go. That's where I want it to go. We'd be getting out, if it broke through the point of demand between the two peaks, and that might be a fraction of that $217. But we know at least that's our worst case scenario, and we're going to commit to being out if that's the case, because we never get into a trade with an open-ended loss ability. And I want you to think about those words very carefully, because I think many, many people in their superannuation funds literally right now own something like this, okay, Commonwealth Bank, and they will say, I'll hold on to this forever. It doesn't matter how low it goes, I'll always hold on to Commonwealth Bank. So they're actually getting into companies and their total risk is everything they've got. Okay, and I don't agree with it just on the basis that something's blue chip, it'll never go down. There's lots of blue chip stocks, and I can quickly find one, because how blue chip was this not that long ago? And now it's a fraction of what it was. So, I've given you the James Bond going into the Monte Carlo casino analogy. Anytime you get into any risky investment, we started this conversation with the fact that shares are a big ball of risk. You need to know what your exit is. I'm trying to think if there's anything I need to whip around further, but I've got some questions here that are kind of leading me in that direction. Helen's asking about the iron ore price, and I was going to head over, I promise you, to the commodities next, because I think once we've talked about interest rates, we've talked about stock indices, we should head over to, and we've even talked about what's happening in China. I think the natural progression is to head over here, and let's talk about iron ore, and let me zoom in on that one for you. But we're very much stuck in the middle at the moment, aren't we? We've had the rally. For me, surprising is not the right word. Does it surprise me that we've got stimulus talks and iron ore then goes up? Of course it does. But surprising in terms of, look, it was looking pretty bad, wasn't it, prior to that, breaking through 700. So good luck to iron ore. So it's worked out well. And we've pushed up, I think, into a pretty logical area of supply. So if you look at sort of through here, so the old point of demand, which is this one here, and the trend zone, mind you, now beginning to sort of act as an area of supply. The good news is we did get it back above that long-term trend zone. I know it's very flat, but it can still offer dynamic support resistance. Look, as long as we hold 800 here, I think iron ore's okay. If we pushed it back beneath that, then we could be heading back down to the lows again. But I'm going to go, buy, hold, sell. I'd say hold at this stage. I know we can't actually trade it, but I'd say hold. And I know that's going to have ramifications, obviously, for your iron ore companies. That's why Helen's asking. But let us head while we're here, and let's have a look at some of the other big industrial metals. I might actually do this first, because I know I've got a line chart there. Maybe let's zoom out a bit, zoom out a little bit more. And we can just see just the general trend there. Did iron ore get, did Aluminium get that big boost? Key industrial metal, did it get a big boost from the China talk? Not really. I think that's still very much heading down. So what we're looking at here is the outlook for global growth over the next 12 to 18 months. And I'd say that's pretty dire. Copper, did get a bit of a rally, didn't it? And I won't go to the high-grade copper chart, but we did talk about over the last couple of weeks, in fact, moving any short positions we had there to a neutral, to a break-even level, and you're probably out at break-even on that short trade. Does that mean you go long here? No, I don't think you can go long, because I think the long-term trend is still very much under pressure. I would suggest you neutral at best, but probably, as you can see on this chart, skewed to the downside, and I don't want to mess with that. There's every chance we hit the zone, all right, and down we come again. So for the copper bulls out there, maybe, but I think it's too early to really pile or plunge into that, given the chart we can see on screen. We have talked about iron ore, and I know that won't work simply because there's a percentage sign in here, and you know what, computers, they do funny things when they see symbols that they don't like. There's the iron ore one there. We'd see the bounce at the end. This is the one in US dollars, ladies and gentlemen. So compared to the one we saw before, which was traded in yuan per ton. Now we go to lithium, and lithium prices have continued to edge higher over the last couple of weeks. And I say edge because that is a contrast to the huge acceleration they got from those lows. We're settling, as I said, we'd settle probably somewhere underneath this dark pink zone. And the next big break, I think, will be decisive. So if it breaks up from there, hey, lithium bulls, you're in business. My gut says it'll probably break down from there, just in line with the breaking of the trend, but I'm going to wait until I see it. Lithium hydroxide prices continuing to edge higher as well. No red flags there just yet. So if you're a lithium bull, you're okay. Big pop in nickel last night. Maybe it was short covering. I don't know. Maybe it was the China thing, but a big pop. How big's the pop? Well, not very big compared to how much it's fallen since just after Russia invaded Ukraine. Still very much a long-term downtrend there. So not getting too excited. Lead, actually, that's a pretty decent rally on lead, but overall, I think still very flat. Then we're looking at tin. Actually, tin looks half decent here, doesn't it? Because it's kind of getting above that long-term trend zone. And yeah, the price action is not too bad. So lead and tin, not as bad as some of the others. And zinc, still looking pretty awful there, but at least rallying off those lows. So I've done Helen's question there. I've got, we're just about here. So let's head over to uranium, continuing to inch higher there. This one's for Nicola. Has to be uranium this week, doesn't it? Look, maybe, I don't know. It's heading in the right direction. And whilst it's continuing to do so, hopefully the hype around it continues to build. I've given you plenty of uranium stocks in the other sessions to look at, and they're doing pretty well. But nothing so sinister in the chart of the commodity yet to suggest that we can't continue to stay the course on the long side for uranium. So still pretty happy with that one. Look, the key level, as you can see, no doubt about it, it's up here. That's the one. If we get above that, uranium bulls, that's your time to shine. Until then, 60 is such a key psychological point of supply. Between that sort of 60 and 65 US dollars a pound, it really does equal go, no go on a bunch of development projects. So that will be the key, I think, point of liftoff for many, many uranium companies as well. Now, I've got a few, I'm going to get to the Forex ones, but just while we're doing commodities, that's why I'm over here. And we are going to check, I should check the chat over here. I'm not sure what that means, Neil, but hello. 1574, not sure. Short dominoes, says Neil. Coal, let's have a look at coal. Good place. Let's head over to energies. Neil, that's a good idea. Where's the best place to do that? I'm going to head back to this one here because I have all of the futures charts ready to go. So let us head to futures and Forex now. And I need to click something. That's what's going on there. Get a reasonable amount of zoom back on the screne. And we're going to jump to coking coal. So let's do the energy commodities here. A little bit of a bounce. Maybe you can't see it there because it's we're getting a PM fix, a PM afternoon fix only on that. But you can see the tiniest of blip ups. Is that a reason to go out, rush out and buy coal stocks? I don't believe so. Brent bumping along the bottom. I think we've got a big break lower in crude oil, despite what the Saudis say. There's still plenty of supply out there. You know, Russia, some Latin American countries, and the US still looking to turn the spigots on, and that'll be good for inflation, ladies and gentlemen. It'll be good ultimately for interest rates and company profits. A big breakdown here could really help the share market. Obviously not if you've got energy companies, so that everything else trade. There's crude oil looking pretty weak as well. Heating oil, probably one we can't trade, but just looking for the shape of the chart. Let's head over to coal. You know, again, a lot of hype recently about coal companies. I can't see why based upon the commodity chart, but hey, companies, it's all about earnings, isn't it? And that isn't always reflected on the price of the commodity. Certainly if they're digging it out of the ground cheap enough and still making money, that's still potentially good for the company. So don't assume, therefore, that because this does look pretty lousy, that your coal company necessarily will go down. I don't think it'll be helped though. Natural gas, very interesting. We had a bit of a failed toe in the water there, didn't work out. Still like to keep an eye on it because I'm noticing that's the one on NYMEX in America. It's American natural gas. This is the one that trades out of the Netherlands. This is a European contract, and you can see that one is turning back up, if only very slightly. So let's keep an eye on that. We've got gasoline here, which is remaining stubbornly high, even though crude prices are coming down. Probably something to do with refining margins. Read as refiners gouging the hell out of us, and that's why we're not seeing any relief at the petrol pump. And well, if we why not look at the uranium price twice? Hey, no reason not to. And this is the high grade copper I said we wouldn't look at, but we are looking at it now. I still think that looks pretty terrible, don't you? Now we can't do a conversation about commodities without getting to gold and silver. We'll do that next. But I did want to talk about if you did take the coffee trade, it's going okay. You know, I think stick with it. Nothing so sinister there as to suggest that we need to bail out just yet. So happy with that. If you want to trail your stops up to break even, no complaints there. We talked about cocoa, which unfortunately we couldn't trade with ThinkMarkets, but it's still doing very, very well if you manage to get it somewhere else. And I'm trying to think of sugar. I think sugar actually looks half decent as well. In fact, I think that looks very good. Look, I think on the basis of this white candle and this white candle, you could dip a toe in the water in this one. But keep position sizes small because we do have a big point of supply up here. If you're wondering, okay, Carl, now you've really lost me because you're talking about trading sugar. So we don't have it. I thought we had it on there. What a shame. Anyway, for what it's worth, I think that's going up. Okay, let's head over to talk about gold. And I'm going to head back here and here. And we're going to look at gold first. And we might head over to where I have all my scratchings, which is, there it is. There's my scratchings. What do we say? I think, you know, we got a little bit positive on gold, didn't we? Oh, that's the silver one. That's silver. Let's go to gold. We got a little bit positive. It's sort of had some nice candles through here. I think this big black candle. So this is the key. I'm not sure if that was a day that we happened to look at it in a webinar. I don't know. It says what's that? The 14th, the second. So after today's 14, we would have been doing this on before that. So I don't think we looked at it on that candle. My point is, if I was there and we're watching it, I would have said, look, you know, all bets are off now. Just call it on gold and stay neutral, because that is not a good candle. And it's backed up by this one, and I think backed up by this one. And I think we can see the trend here is not great. And if we break below 1931, then there's a very good chance here that we're going to come back and test, I think, into the dark green zone at the very least, but it might be worse. Let's give gold the benefit of the doubt. Let's see if we can create a pattern like this again over here, and then maybe we can look at gold longs. But until then, very, very neutral, really probably more skewing to the short side. Silver has done better, but I don't think it's shooting the lights out either. So I would suggest neutral at best on silver for now. Okay, I know there are plenty of silver bulls out there. I think we need to go to the foreign exchange pairs now, because we've done not only all of your requests I can see on this side and on this side. I've even done 10 for Ron over there. We're going to head to the foreign exchange. We might finish off there. So let's go back to here. If you've got any other questions, now's the time to put them in, or forever hold your peace. Let us head down to the Forex and a couple of trades we've been monitoring. Now, we talked about this one last week for a long, didn't we? I don't know if you managed to get the trade on. I gave you all the parameters. I put them in the ThinkMarkets platform, and I bet most of you didn't do anything about it. You said, "Oh, that's very interesting," and didn't do anything about it. What a shame, because it's going very, very well, and it's going very well for all the reasons that we talk about on any chart. The point I'm making is, does it matter if that's your favorite lithium company, or does it matter if it's the Great British Pound versus the Japanese Yen? I'd argue not. Are there any great trades we can find this week? And look, if you're not on it, it's a little bit of a ways away from the light green zone, isn't it? But it still looks very good. And I think since last week, obviously, there are at least a couple of great white candles that you could have even added some risk on and be holding a really nice position on GBPJPY at this point in time. We at the very start of this presentation, we looked at those interest rates and we said, well, what are the ones that are really rampaging? And GBP was certainly one of those. And the way foreign exchange works, ladies and gentlemen, is the higher the rate, the more demand for the currency. It's very, very simple. So something like that should do well. Anything against the yen, even as much as we're seeing a bit of US dollar weakness across the board. We looked at the dollar index, that's that one there. All right. The yen is just even weaker. So I think this is a pretty good trade as well. Notice I said pretty good. It's flatter than the sterling, and it doesn't have my fundamental backup in terms of what's happening with the interest rates, okay? But hey, US rates are probably still edging towards the upside. So I think a valid trade, an absolutely valid trade. So maybe let's set this one up. So in fact, look, it's right. That candle right there is exactly where I want to get in. So it is going to be a valid one. So let's say we want to stop loss at sort of 138. Well, let me get the low of that and I'll be able to tell you exactly. So that low there, look, a 138.27 I think is probably a good level. You never go exactly at the low. You always want to give it a little bit of room because when stops get run, you don't want to be knocked out of it. So maybe even like a 138.17, giving it even more room. And targets, well, there's a little bit of supply here, but given this consolidation is so close to it, I don't think that's a big issue anymore. And I think the next level is probably into, say, a 140, high 144s. So let's see how that works out on the web trader platform. So we're going to go USDJPY and click on that. Everything resets, of course. We get the current chart. I'm going to click this button selected because we are looking to buy, not sell. You know, again, if you want to use the methodology of being able to exit in thirds, you would tick that up from your minimum. 2 clicks gets you to something you can then exit in thirds, okay? If it ends up being too big for you here, then tick it down again, okay? And just be in and out, that's fine too. Okay, so we said 138.17 and we said 144, and I'd go high 144s, but not to the round figure, even like an 87. Do we have at least 1-to-1? We certainly do, so happy days. I'm going to leave that off because I don't think I need to put a take profit in the system. I'm going to monitor it, but I prefer, I think, just for my own peace of mind, to leave the stop loss on. So at least if it gets down there and I lose my $88, the computer will execute it, and it won't be me going, maybe I should, maybe I shouldn't, maybe I'll hold on a little bit longer and then not do it and end up losing not $88, but $188 by the time I finally give up. So otherwise, everything looks pretty good here. I don't see any reason why you wouldn't. I'm not going to fuss around. So some people go, oh, let me see if I can get it at 140.97. It's just irrelevant. This is only a demo account, so it won't matter, but I'll click the confirm buy down here to show you how to do it. By the way, you will need, for the 3,000 units, $147 in your account. That's not profit or loss. It's just margin, and margin is returned to you at the end of your trade, and then your profit and loss is calculated separately. So you click confirm buy, place order, and you can see it's just a demo account, and it already has appeared down the bottom here. And you can see, oh, I'm losing 9 cents now, and that's simply because there's a spread on the trade. So the difference between your entry price, you're always paying the offer price, but if you have to get out, turn around, you're going to only get the asking, the bid price, okay? And there's always a gap between that. And what I would suggest to you is turn off your screen now and stop looking at this little number here, because you'll become obsessed with it. Oh, 3 cents profit, how good's that? Now it's back to 0. Now I'm losing 3 cents. Now I'm losing 9 cents. Are we going to play this game, ladies and gentlemen? Please. Oh, now I'm up 25 cents. I better get out. Please, please, please do not play this game. Okay? Set them, forget them, and come back in line with your periodicity. And you know I'm a daily trader, which means I come back at the end of each day and then look at the candle, and I just do what I see. Okay, and I don't get too fussed about, I don't keep score based upon that little flashing P&L line. I keep score based upon what do I have to do based upon my methodology, and did I follow my methodology? That is the USDJPY, so that's ticked off Craig's request. Perry asked about the GBPJPY, which I have given you my thoughts on that, Perry, which is, it looks amazing. Continue to hold it. And the path tool from Haraju. The brush icon, fourth from the top, that's the one there. Brush. Oh no, this path. The path, that's the one I like. Haraju, you are a legend. Well done. I'll be using that from now on. And I think I've done. Kirsty saying not much to see here. Carl, it's hold your horses. So I'm not sure what that is referring to. But hey, I think we've done all the requests there. So let us adjourn for the day and head back over to here and remind you, if you haven't already, to register. We're still working on the registration page. I'm sure it's not far away, but in the meantime, just ping Nick Coulson, N Coulson at thinkmarkets.com with your interest to come and hang out with me for a few hours in Melbourne on the 22nd of July. IRL, in real life, ladies and gentlemen. We do too many of these streaming things, isn't it? Offline. And what a great opportunity to come out and meet people and speak to people just like you that are learning how to invest better. And to help you in that regard, I have two of the best, two of my buddies. This is the first one ThinkMarkets has asked me to organize, and I went to these two guys first for a good reason, and hopefully do many of these. I'm just going to keep hitting all my trading friends first and foremost. But you absolutely must listen to both of these gentlemen speak. They are the best in their respective fields. And I won't go into their topics, but trust me, you want to be there. So hit up Nick and let us know that you will be there. And if you're not viewing all my other sessions, this is the way to do it. Tune in on Tuesdays for the ASX edition. Obviously, today we do the Indices, Commodities, Forex, Crypto Thursdays. And then tomorrow, it's going to be so exciting tomorrow, the USA edition, we'll review all of our AI picks, won't we? And some really solid moves back to the upside for some of those FANG stocks as well. And illustrating just why we use that exit 1/3 method. Hey, head to www.thinkmarkets.com/au/webinars for more details. If you're not a client of ThinkMarkets, well, you really should be, because we are the good guys in the broking scene all over the world. I do have international listeners now, and we've probably got an office near you, because we do have offices all over the world, and we're regulated by those various jurisdictions, which means we're a very, very safe company indeed. If you're trading in Aussie, that's the details there. If you're trading anything else, you're probably going to want the CFD account, where I just showed you how easy it is to open trades and manage your risk as you go. www.thinkmarkets.com/au, the best platforms. We keep getting nominated for awards. We just got nominated for another one, and the customer support is amazing. We don't have AI chatbots, plenty of intelligence, but they're not artificial. They're real people, and they're there to answer your questions. And you can call them up and speak with them, because we don't hide our phone number like all the other brokers. You can call us anytime you like. If you're watching me on any of the streaming services, please hit the subscribe button to stay notified of any of my future updates. And it's so important you hit the thumbs up button. Really important you do that because it lets me know you like what I'm doing and I'll continue to do more of it. Apart from that, it's been such a pleasure chatting with you today. Hopefully you learned lots and had fun. I did. All the best. Until we catch up again. Bye-bye for now. Before you run away, don't forget that everything we've discussed today is general advice. It has not taken into account your personal financial circumstances or particular details. So, before acting upon it, do all those things or seek the help of a financial professional. You can learn everything you need to know about ThinkMarkets and our products by heading to our website and downloading our PDS.